Hi, I'm joined today by Dave Raub, President of Outlook Capital Management. Dave, thank you so much for your time today. We're excited to dive into the economy. Dave, why is this housing boom different than the last one that resulted in a 2009 bubble?
It's a great question. Lots of people are wondering that same thing right now. In a nutshell, in 2007 and 2008, there were too many unqualified buyers, too much bad mortgage debt, in a word, too much reckless lending and reckless housing investment. In 2021, so far, there is not much sign of reckless mortgage lending. And such indicators as buyers' cash offers for homes seem to be near historic highs. So anything is possible, but I would be pretty surprised if the banking and financial sector dared to approach the sort of reckless lending behavior that characterized it 12 years ago. Banking has been under the iron fist, so to speak, of the Federal Reserve and the banking regulators since 2009. They have tightly restricted their lending risks and their ability to distribute earned cash to shareholders.
What do you think the runway is for the growth we've been experiencing?
Another one that everybody's thinking about. My answer to that is from 1 to 5 years. Big range. And if that sounds like a wild guess, that's exactly what it is. The tailwinds right now are financially strong consumer and business sectors, especially in the US, and not all that bad elsewhere in the global economy. And another tailwind is a global economic recovery, which is unfolding gradually due to the sharp differences mainly in the status of lockdowns around the world. The United States, pretty much as a whole, is slowly and painfully leading the reopening. Europe is far behind. Asia varies from place to place, and other so-called emerging economies are in various conditions. And you can see that as bad news, and right at this moment, it's contributing a degree of economic weakness. But I think in the bigger picture, it's good news, because the lockdowns, in the end, they're only going in one direction. They're going to be eased off because the vaccinations slowly are going to make their way around the world. And that will be an ongoing, gradually strengthening tailwind for growth. So then you say, well, okay, what are the headwinds? So the headwinds are not blowing in our faces just yet, but they will begin to do that in the next year or two. The first one, main one, is rising taxes and regulations. That's a touchy subject, because everybody, depending on their political viewpoint, has different point of view on taxes and regulations. What I would say, though, and what I do say to clients who ask me, is that no matter what our political viewpoints might be, rising taxes and regulations are not the ingredients for the strongest possible economic growth. And there is a fair constituency taking the thought of rising regulations and sharply rising taxes pretty seriously right now. So that is a potential headwind, which really hasn't gotten rolling yet. I would say as serious or more serious in the headwind category, though, is inflation. Inflation would be due to money printing on a scale that we have not seen in modern history. That inflation will show up with a lag, and I think it's going to start slowly. I don't think it'll cripple growth until it begins to actually look frightening. And today's inflation might be running 2%, 1.5%, as it has for a very, very long time. What levels are frightening? Great question. When you compare with 1.5% and 2%, levels at 4% and 5% will start worrying people. The United States has experienced, of course, inflation in the 15, 16% range a long, long time ago, toward the beginning of my career in the late 70s and early 80s. And it kept growing, so it's not it is not that there's any particular level of inflation which is a torpedo under the waterline necessarily for any economy, but inflation, which seems to be rising fast and most importantly strikes people as out of control, is a problem. And it's a problem because it causes businesses and consumers all over the place to get more cautious, pull back, and that slows down economic growth.
As consumers start to go out and about with lockdowns lifted and the positive momentum with the increase in vaccination rates, what is your perspective on the retail sector?
I think it's going to do well. And it's when I mentioned that 1 to 5 year growth estimate, how long this growth runway will last. Of course, 45, a long time ago, when I was in economics graduate school, one of the elementary things you learn is, well, what's the makeup of the economy? And the answer back then was 2/3 of it, roughly, is the consumer sector. Interestingly enough, it's roughly about that today. So, if the consumer sector is sick, the economy is going to have a problem. If the consumer sector is strong and healthy, it's quite a tailwind. And I think that we can expect the consumer sector and the retail spending to do pretty well for a pretty sustained period of time for all the main reasons, I've touched on here. First of all, absolutely first and foremost, household financial strength is still off the charts on any long-term historical comparison. It's still astonishingly good. And the funny thing about that is, we always have to be careful. We all hear anecdotes, and of course, the newspapers love to headline anecdotes, horrible stories of people taking terrible financial risks, harking back to 12 years ago and so on. But anecdotes actually aren't a description of the whole world. The best we can do for that is statistics, which have their own flaws, but they generally give us a better grasp of the big picture. And those 6-year numbers that show how strong the household sector are really impressive. So here we have a very financially strong consumer and household sector, which is received an almighty fright, and certainly did its share of pulling in 2020. And now, slowly but surely, the fear is subsiding, and it is kind of slow, but it is absolutely subsiding as vaccinations spread around, as headlines about hospitalization rates and the bad news about the virus gradually, it subsides. Barring some kind of unexpected thing. The nature of where the retail spending happens, of course, is the same change that's been happening for some years between digital and physical. And that is a story that's not done playing out yet. And, of course, it's very, very easy today and we hear a lot of people saying, yeah, the story is all over. Digital is one. The physical, retail space is doomed. We won't see it anymore. I'm a bit of a contrarian there because confident sweeping generalizations about the future so often turn out to be mistaken. So I suspect that there is some level at which the physical retail side of the retail sector is not done yet. And there will be a return to it, particularly as people start feeling just more confident about the future. It's a very different industry, but we're actually seeing exactly the same kind of phenomenon happen in airline travel today. Airline travel dropped a completely unbelievable 98% in March and April of 2020, and gradually clawed its way back to 60% under the 2019 norms, and it kind of stayed there for so long that people began saying, that's it, the business travelers will never return. People are just too cautious to change and so forth. And that was 3 or 4 or 5 months ago. What's been happening lately? Airline travel is rising. So right now, the TSA throughput numbers are kind of trending at about 35 or 40% under 2019's norms, which are levels that seemed doubtful as little as 3, 4, 5, 6 months ago. People do want to behave normally. and they can be knocked off their normal stride for quite a while, but that doesn't mean the impulse to behave normally has gone away. And I think that that's true of airlines, and I kind of suspect that's true of the physical side of retail too.
What is key to sustain profitable growth for a company in today's world?
My answer to that is there's no such thing as sustained profitable growth, except for those occasional celebrity tech companies which are on the leading edge of something great, that they've invented or the industry's invented, and they have a nice ride for a while, sometimes for a startlingly long period of time. But everybody else is ultimately strongly affected, if not controlled, by cycles. They're particularly industry cycles and/or the general economic cycle. So, I think the key, instead of sort of asking as somebody running hardware stores, home improvement stores, somebody in that industry today, how do I get sustained profitable growth? To me, the most important question that perhaps I would be asking is, how do I most protect myself from the next cyclical downturn, and be confident we will have it? And for that, that's you never stop controlling debt, and you never stop controlling costs, which does mean a balancing act between your growth opportunities and the goal of risk reduction by debt and cost control. I think that's the right way to look at sustained growth. And I think one of my favorite proofs of how valuable that is comes when I look at you might call it the last 15 to 20 years, since about 2000, since the dot-com bubble, and what's going on with the U.S. economy, and what has gone on with a great many non-tech companies, old line industrial companies, Caterpillars, Cummins, even the oil companies, manufacturing concerns, 3M, and so forth. And what you see with so many of those companies, especially since the financial panic of 2007 and 2008 and 2009, was the huge benefits of what they did. They reacted to an almighty fright by cutting debt down, cutting costs, really controlling their financial risk, learning how to operate more lean, and therefore they began on every single upside. They made more dollars of profit per dollar of sales than they had in the prior upcycle. And company after company, when we see the last several cycles, from sometimes as far back as 20 years ago, 2000, but especially since 2007, 8, 9, you see a succession of higher highs and higher lows in their earnings, cash flow, and actually in rewards to shareholders as well. And you see those things. One of my favorite companies is Caterpillar as an example of that. Another one is Cummins, a diesel engine company, but they're just similar to many. Here you had companies which 20 years ago completely expected to lose a ton of money at the bottom of a cyclical downturn. Now, several cycles later, oh my goodness, they're making as much or more money than they ever made on the upsides. So it's these cycles which never go away, but they're going higher and higher over time. So they're higher highs and higher lows, and that is entirely due to the people running those companies never taking their eyes off controlling their debt, controlling their costs, and doing a balancing act with investing in the future too. So I find myself humble when I put myself in a position of giving advice to a lot of your clients and perhaps people listening to this presentation, because those are people who've been running stores in the trenches for a long time, and I'm a generalist sitting here in a lofty financial office. But I think I would say to those people, look at the spectacular success at managing the cycles that people who've balanced their act between controlling costs and controlling risk and investing in the future have done, and use the fat years to get ready for the lean years.
Dave, thank you so much for your time today. We appreciate all your insights, advice, and perspective on not just the economy, but the consumer at large. Thank you.